Coming up on today's show, ECOWAS foreign and trade ministers seek three-phased reopening of regional borders from the first week of July. OPEC sees a gradual recovery for global oil demand in the second half of the year. Plus, Ghana's economy grows 4.9% in the first quarter of 2020. Thank you for joining us on the program. I am Bisi Adebayo. We kick off from the markets right away with intraday numbers coming from the stock markets in Africa, where the numbers are mixed at intraday. Here in Nigeria, the all-share index appears to be sustained in Wednesday's positive tempo with a 0.28% gain at intraday. On the flip side, South Africa's JSE index was down 0.17%. And the EGX30 in Egypt was also 0.43% down at intraday, while Kenya gained 0.11% on Wednesday. And most markets in the Middle East continue their bullish run at intraday, except the Abu Dhabi index with a 0.71% decline, while Dubai rose 0.36%. The Qatar index was also 0.98% positive, while the Saudi index gained 0.38% at intraday. And in Europe, stocks pulled back slightly this morning as investors watched a surge in U.S. coronavirus cases. But let's talk to Orich Betts, who joins us from the Frankfurt Stock Exchange to tell us what's driving today's markets. Good afternoon, Orich. So it promised to be a cliffhanger, and of course it was. Today, the German digital payment services company Wirecard was due to present its 2019 results after postponing twice already, much to the dismay of investors. But the results still didn't come. What happened?
Well, Wirecard says that its accounting firm told it that it was unable to find evidence for around 1.9 billion euros in cash balances. And this on the day that the results were to be presented. It had been the fourth time that this presentation had been delayed. And people here in Frankfurt are aghast at the development. The shock is huge. People are saying they've never seen anything like this in a comparable company like Wirecard, which is also in the DAX. Wirecard itself claims it's innocent. It has from day one these charges that they're accounting irregularities. They've been going on for some time. Wirecard has always said not true. And it is filing charges against persons unknown because it believes itself to be a victim of a giant fraud. An analyst I talked to says he doesn't believe a word of it. They've had more than enough time to clear this up.
So what does all of this mean for Wirecard?
Well, for the shareholders, it's another disaster, a disaster on top of a disaster that went before. Already since these charges started, Wirecard has been losing value in the stock market, although on the surface of it, according to the numbers that we know that the company has published so far officially, it's making good money with its business. But now, today, the most that it was losing today was 66%. And at the moment, as we speak, it's around 55%. That's just the loss this day. And that brings it to a market valuation that could perhaps bring in question its membership in the DAX. And speaking of the DAX, the Deutsche Börse, which is the operator for the stock market here, is starting an investigation into sanctions. Informed sources tell me that it's unlikely that it will lead to any consequences because it would be a first offender.
Well, before I let you go, Orich, the Bank of England met today on monetary policy. How are the markets in Europe reacting to the bank's decisions?
Well, it's not doing anything to the markets positively, at least. If you look at London, the FTSE, it's down by about 1%, even though the Bank of England did say that it was adding another £100 billion in asset purchases, that is, putting cash into the market. And this on top of about $200 billion that they announced in March. It's leaving its key rates unchanged. You mentioned the surge in corona cases being a reason for the markets going down. That holds true also for Frankfurt, where the DAX is down by over 1%, and the CAC 40 in France down even a bit more than that.
Thanks for those updates. We'll see you again tomorrow.
Thanks.
And so let's see how the markets in the UK are actually reacting to the Bank of England's latest announcements with Juliana Olayinka, who reports from our London studio. Good afternoon, Juliana. So let's take it off from where Orich stopped. Now, the Bank of England has announced more economic stimulus. It's expanding its bond buying program known as quantitative easing by a further £100 billion to help Britain's economy get through its worst economic downturn in 3 centuries, and also kept its key interest rate unchanged. Tell us how the BOE's decisions are shaping the markets at intraday.
Good afternoon, Bissy. Well, similar to what Orich was saying in Frankfurt, it hasn't really had a major impact on the FTSE because, as everybody will be clear of, the FTSE all-share, particularly the FTSE 100, that has so many international traded companies that they really look at domestic issues within the UK. But it is still a big news story, and it definitely has reverberations. A lot of analysts and economists had expected quantitative easing to be increased. In fact, Andrew Bailey, the Bank of England governor, had been speaking about it throughout the week. There were some suggestions that it could actually be increased by up to £200 billion, but no, it is £100 billion. Interestingly enough, not all Monetary Policy Committee members agreed to this stimulus measure. Andy Haldane, who's pretty popular economist, in fact, he's the chief economist of the Bank of England, he actually voted against it, but it did go through. And as you said, they did decide unanimously to keep interest rates at a historic low of 0.1%. They didn't follow suit of other central bank governments around the world by going into negative territory. I think another thing that people have picked up on is some remarks they made on their minutes, which they always release after their meeting. And what they did say is, even though, of course, UK GDP at the moment is down 20.4%, they said if they look forensically at data coming from the globe and coming from Britain, that in Q2 they do not expect the global economy or the UK economy to contract as much as they had previously thought during their May meeting. So a lot of people are picking up on that, and you can't get away from the second wave of infections. They said that depending on how the British economy will grow will be dependent upon how the developing world will recover from increased COVID-19 cases, and whether or not a second wave of infections will have a dramatic impact in the West. So pretty telling there. And so at the moment, asset purchasing from the Bank of England stands at a high figure of £745 billion, which is a huge amount, by the way. But let's have a look at those numbers at intraday. The all-share down 0.02%. The FTSE 100 is down by 0.11%. FTSE 250, that domestic market, up by 0.03% in response to the MPC. In currencies, the pound down on the US dollar by 0.44%, down on the euro by 0.54%, and down on the Japanese yen by 0.44%.
Right, Juliana. So this could just be some good news for some after all, as DPD and Kingfisher have announced plans to hire 7,500 UK staff to cope with surging demand for home deliveries during the coronavirus pandemic. At least this will provide some relief, won't it?
It will provide some relief, absolutely. There are always winners and losers in a downturn and a pandemic, and online delivery has definitely been one of those winners. DPD are a major delivery giant here in the UK. You look out the window, you always see one of their vans, and they have announced that they are going to be creating 6,000 new jobs. This will be for full-time staff in their warehouses as self-employed drivers and in all aspects of the business. B&Q owner Kingfisher, on the same day, they've also announced that they will be creating 2,000 jobs. And both companies, as you rightly said, Bissy, are just reacting to the unprecedented surge in online delivery and also the caution. There's so much precaution, which are going back to some of the minutes that Andrew Bailey released. Britons, even though the lockdown is still being eased, are still being very, very cautious. They're not just stepping out. And this is obviously increasing online sales. Even though the shops are open, some people prefer prefer to shop online, which is why we're seeing a surge in demand. And this is resulting in new jobs being created.
One last thing, Juliana, let's talk about this report from the Center for Aging Better, which has raised concerns about the impacts the lockdown would have on the health and finances of people as they approach retirement. Now, the study says that the coronavirus crisis could leave the next generation of retirees significantly poorer and sicker. That's certainly another issue to worry about, right?
Well, yes. The new study commissioned by the Centre for Aging Better, they have commissioned this study, and from the findings, they have put some suggestions in line for the British government, and one of them is to not leave the ageing population behind. So this is about people who are in their 50s and their 60s, and these are people who, if they're furloughed, are at risk of losing their jobs. There's a lot of upskilling. There's a lot of change in deployment in how you work. And they said, similarly to what happened during the 2008 financial crisis, there are fears that these are the individuals who will be the first in line for the chop. So they said if this is going to happen over the next couple of months, they want the government to put in line some tailored job seeker requirements so that these people are able to transfer their skills and stay in the job market. There is a little bit of stats that I think I should read out. They also said that 1 in 5 of people in their 50s and 60s during lockdown have seen their physical health deteriorate. 1 in 3 believe that their mental health has worsened, and 37% of people in their 50s and 60s during lockdown have been drinking more alcohol. So yes, they don't want this age group to be the forgotten, but this is a discussion that's been on and on in the UK, and I'm sure across the world, Bissy, as people are really struggling with life in the lockdown, but they don't want all the focus to just be on younger generations.
And we hope that things really don't get that bad, Juliana. Thanks for those updates. We'll see you tomorrow. And stocks in Asia were mixed on Thursday as investors continued to weigh the implications of a recent uptick in coronavirus cases. In Japan, the Nikkei 225 dipped 0.45% to close at 22,355.46, while the Topix index declined 0.25% to end its trading day at 1,583.09. South Korea's Kospi also slipped 0.35% to close at 2,133.48, and Hong Kong's Hang Seng index closed fractionally lower at 24,464.9. Shares of e-commerce giant JD.com jumped in their Thursday Hong Kong debut, rising more than 3% as compared to the issue price. Mainland China's stocks notched higher also, with the Shanghai Composite gaining 0.12%, while the Shenzhen Component added 0.645%. And in the U.S., stock futures erased earlier losses and were flat after a disease expert in China announced the latest outbreak of coronavirus cases in Beijing had been brought under control. Futures on the Dow Jones Industrial Average fell 30 points, or 0.1%. Meanwhile, S&P 500 futures were higher by 0.1% earlier, and the futures for the Nasdaq 100 were seen around the flat line. And global demand for oil is expected to see a gradual recovery later this year, and that's according to the latest forecast by the Organization of Petroleum Exporting Countries. In its monthly report released on Wednesday, OPEC expects demand to decline by 6.4 million barrels per day in the second half of 2020, which is less than the 11.9 million barrels per day drop in the first 6 months of the year. However, OPEC cautions that downside risks remain for consumption in top consumer, the United States, despite reduction of the global crude oil surplus following the deep cuts in output by its members. The Technical Committee of OPEC and its allies and an OPEC Plus ministerial panel will continue their meeting today to review the supply cuts' impact on the market. Meanwhile, oil prices have turned positive after shedding about 2% earlier on as a spike in new coronavirus cases in China and the United States renewed fears about demand. Brent crude was up close to 1%, trading around $41 per barrel, while U.S. WTI crude futures were also 0.6% up at $38.20 a barrel, Worries about fuel demand rose after a surge in coronavirus cases led Beijing to cancel flights and shut schools, and several U.S. states, including Texas, Florida, and California, reported sharp increases in new cases. Still to come on the program, a look at the latest developments in Nigeria's petrochemical industry. You stay with us. Welcome back. Nigeria's petrochemical industry has struggled for decades until the privatization of the element plant, also known as Indorama. Polymer is the major product of the petrochemical industry, as polythene, its main derivative, forms the base material of all plastic materials, packaging, and plastic sheeting. A research analyst at the financial derivatives company Nosike Nwajide will be talking to us about the latest developments in Nigeria's petrochemical industry. Good afternoon, Nosike. Thanks for coming on the program. So Indorama Element Petrochemicals Limited is one of the biggest players in the Nigerian petrochemical industry, but with Dangote ultra-modern petrochemical plant to be fully commissioned in January 2021, what do you think will happen to the industry?
I think it's a game changer for the industry, really. With Indorama accounting for 85% of the market share, I mean, if you have a player like Dangote who's building conservative estimates that puts Dangote's petrochemical outputs at 2-3 times the size of current industry output. So if you're tripling industry outputs, that is significant. I mean, the impact on jobs, the impact on the country's GDP. Indorama currently employs about 1,200 people. I mean, Dangote's ultra-modern complex should employ maybe twice that number. We don't know yet until they get on stream, but the impact is significant. Then again, I mean, if you have one player and the addition of another big player, the market becomes an oligopoly. And with an oligopoly, there's increased competition and a price war could possibly ensue. And when that ensues, obviously the customer wins. The players begin to compete on the basis of price. I mean, increased competition leads to increased efficiency. And when the consumer wins, the consumers really are the people who purchase the plastic raw materials from the petrochemicals industry and the plastic manufacturer. So these manufacturers are already grappling with high costs in all their inputs, and if you have lower cost for a significant input as the essential raw material, that should drive down their costs. Then again, if you have an oligopoly, as we expect to see, there's also oligopolies can result in some forms of collusion and reduce market competition and lead to higher prices for consumers. We don't think that will happen, but the possibility exists. All in all, we expect the outcomes to be significant for the petrochemical industry at this point.
Now, when you place them side by side now, the Indorama plant has a polymer output of about 360,000 tons annually, and Dangote Group's petrochemical plant is expected to have a polymer production capacity of 500,000 tons. Do you think that the Nigerian market is big enough to absorb the combined output?
I honestly don't think it's big enough, but in this day and age, we have the African Continental Free Trade Agreement coming, hopefully, by January 2021. The market becomes continental, not just domestic or regional. We have, I mean, when you have a domestic demand, I mean, the rest can be exported to countries all over the world. At the moment, we have Indorama exporting to about 20 countries, not just in Africa, but beyond that. So we expect to see increased competition, not just between Dangote and Indorama, but with petrochemical exporters in the sub-region, in Senegal, in Ivory Coast, and from even Gabon. And that would increase exposure to competition. After that, we increase it to competition and to make you more efficient, leading to increased, you now compete on the basis of price. You have a lower cost, and your profitability should increase, and you strategically position yourself to compete on the continent. On the other hand, the AFTA will also expose these plastic manufacturers who demand for these raw materials would also have increased, expose them to the continent. If they have an increased market, they would scale up. And if you scale up, you would demand more of these raw materials. So on both sides, I mean, indirectly and directly, AFTA stands to benefit the industry. And the industry size as it is, I mean, it's uncertain what it is now, but it shouldn't matter. The exports to the African continent should be where both companies are looking at.
Now, the FMCG industry is one of the major end users of petrochemical products for packaging, and many firms have vowed to lower their patronage of non-recycled plastic in the near term to reduce plastic waste. Well, what will be the impacts of the global shift to recyclable plastics on the fortunes of the Nigerian petrochemical industry?
Okay, in addition to trying to lower costs, businesses are becoming increasingly more conscious about issues bordering on environmental, pollution and climate change and greenhouse gases, all of that. So the movement to reduce plastic waste is likely to lead to, obviously in the short term, a decline in industry output. However, the plastic for packaging is not the only source of demand in the industry. There are numerous uses for the polymer. There's polymer in textiles, there's polymer in the molding of plastic chairs and even toys. Plus, there's also a growing use of polymer or plastics as a cheaper substitute for rubber and glass and metal foils, industrial uses. So the loss in demand from the FMCG in the short term will be made up for, offset by increased demand from other industries in the medium to long term. So the industry should be strong and should expand, should grow in the medium term.
We'll see if that happens. Research analyst at the FDC, Nosike Nwajide, thanks for speaking with us on the program.
Thank you.
In other news now, ECOWAS ministers are proposing a three-phase reopening of the region's borders starting from the first half of July, allowing in travelers from other countries with low or controlled levels of coronavirus spread. The new proposal, contained in an ECOWAS summary from a virtual meeting between foreign and trade ministers, calls for coordinated efforts to reopen cross-border trade crippled by the imposed restrictions. The first phase involves the opening up of domestic air and land transport, while the second phase involves opening the land, air and maritime borders within the region. The third phase, which should occur by July the 31st, includes opening of air and land borders to countries with low and controlled levels of COVID-19 contamination rates. And data from the Ghanaian State Statistics Service shows that Ghana's economy grew 4.9% year-on-year in the first quarter of 2020, compared with 6.7% in the same period last year. Ghana has had one of sub-Saharan Africa's fastest-growing economies in recent years, but the central bank last month downgraded its 2020 growth forecast to between 2% and 2.5% from an earlier expectation of 6.8% due to the impacts of the coronavirus pandemic. The economy grew 6.5% in 2019. Indonesia's economy could shrink by up to 7% this year because of the effects of the COVID-19 pandemic. The country's investment minister, Slim Azabi, says a government study done in partnership with the United Nations shows the number of unemployed people in Tunisia will increase by 275,000. This would raise the unemployment rate to 21.1% in 2020, up from about 15% at the start of the year. The study expects the economy to shrink by 4.4%, but Azabi says the figure could rise as high as 6% or 7%. Tourism revenue in the first 5 months of this year fell by about 50% from the same period of 2019, as Western tourists deserted the country's hotels and resorts due to the COVID-19 pandemic, of course. The government ended all restrictions on movement and visitors this month and would open its sea, land and air borders on June the 27th. It's not any different in the Democratic Republic of Congo, where the central bank has trimmed the country's economic growth forecast for 2020 to minus 2.4% due to the impact of the coronavirus. This is down from a previous projection of minus 1.9%. The central bank said in a statement that this contraction, which affected all sectors of activity, is mainly explained by the measures of confinement of populations, both internally and externally. And that's where we end today's program. Thank you for watching. I am BC Adebayo.